Okay, hello and welcome to episode one of what I'm going to call Show Me the Ropes podcast. My name is McNeil Stout. I'm a young broker in Middle Tennessee, and I'm honestly just curious and interested in learning more about different industries that I and my clients as well often come in contact with. So, my plan with this show is to keep it simple, to bring individuals on from different industries to teach me all that they can teach me in 30 to 45 minutes. So our first interview today is with Charlie Ogden with First Citizens Bank. Thank you, Charlie, for coming.
Absolutely. Yeah. Thanks for having me, Neil.
Yeah, no, I'm excited to learn. I know we've had conversations together over lunch a few different times, and so I'm excited to learn more here because we've talked more about life and things like that than we have about banking. So if you don't mind, if you could start by just telling us a little bit about yourself, who you work for, how you got there, stuff like that.
Yeah, for sure. And thanks for having me. This is my first time doing anything like this, so I'm excited too, man. I originally from East Texas, born and bred in Longview, Texas, about 2 hours east of Dallas. I went to Baylor for undergrad, moved here in 2013, and met my wife about 2 weeks later. And we got married in 15 and moved out to Mount Juliet. We lived kind of in Hermitage and then Lebanon, so always on the east side of town. Just living the dream right now in the suburbs. I got 2 little girls, 1 more on the way, and just couldn't be happier. And it's great. And it's the job's been good to me. Probably better than I deserve, but it's allowed me to meet some really interesting people. And I started out on the personal side. I worked for a regional bank, just doing checking accounts, personal loans, credit cards, some mortgage stuff like that. And then kind of graduated up, I guess you could say, to doing small to medium-sized businesses, which is kind of the commercial side I do now. But it's given me I feel like a good perspective because I've done quite a bit on that side and worked with all different size businesses and a few different banks. So I can, hopefully speak to a few kind of what banks look at just as holistically versus just First Citizens, because First Citizens, it's been great. It's the smallest bank I've worked for, but it's actually the largest family-controlled, family-owned bank in the country. So it's cool. It's a cool dynamic because we, being family-owned, we have a lot of flexibility and some latitude, but we are still big enough that we fall under larger financial institution regulations.
Right.
And we've got plenty of firepower, meaning we can do deals of just about any size. So it's been an interesting dynamic, I guess, to say the least.
Yeah. Awesome. No, thank you for that. That's really helpful. And I know I can already say I've learned a lot about fatherhood from you and just the little conversations we've had because we've got one on the way, as you know. So that's awesome. What specifically, because I know banking is a really, especially even just commercial real estate banking is a pretty broad term. So what type of assets do you focus on the most?
Yeah, so we do mostly owner user occupied. We will look at some investor stuff, but it's a little bit more limited. Within the owner user, I think we're the most competitive is in healthcare and industrial. We'll do just about anything on that side of the house as long as it makes sense, but we'll get really, really aggressive for a good industrial or a good healthcare project. And then,
okay, perfect.
Assets on the non-owner occupied or investment side, like I said, we're a little bit more limited. We're looking for the same asset classes, industrial and healthcare, but it's just a whole different ballgame on kind of how those pencil out, especially right now.
Right.
But that's kind of what we're looking at.
Yeah, perfect. Okay. At a high level, and so the agenda today that I want to kind of walk through is, first of all, getting lending. What does that process look like? And then a little bit going deeper into what does financing look like as an investor, but then spending the bulk of our time, because you do most of your work on the owner-user side. So what does that process look like for an owner-user? But to start, my first question about, financing specifically is, at a high level, how does this process work? I know that's a broad question, but from beginning to end, and then you might want to split it up into investor and owner user. Go whatever direction you want with it, but what is the getting financing process look like?
Yeah, good question. And obviously it depends on whether you are an owner user, whether your company is going to occupy the space or a percentage of the space versus if it's purely an investment type acquisition. It really starts with just having a conversation with the borrower to figure out what they're trying to do. Is it something, first off, that's in our wheelhouse? Because when you're doing some of these larger commercial projects or even small business, that's where banks really start to differentiate themselves. Mm-hmm. Obviously, every bank can open personal accounts. Everybody can do checking accounts and credit cards and treasury services. But the lending is where banks kind of put themselves in certain boxes, I guess you could say, of like, all right, and now every bank loves healthcare for the most part. Every bank loves industrial, but some banks really like retail or like restaurants and things like that. Some banks don't like them at all. The same thing with GCs, contractors. It all just has to do with certain regulations around those companies. And typically what you'll see is the smaller the bank, the more risky they are, just because they're kind of fall under less regulations. They find ways to kind of mitigate those risks, but then what most people will see is as the bank gets bigger, the less risky deals they do, and they kind of focus on whatever their core industries are.
Yeah. And I guess
for us, in my job, I just,
yeah. Sorry, I was
Yeah.
just gonna say that makes sense. Like even in the that essentially seemingly is true in all sorts of businesses. When you got more on the line, you've got less of a tolerance for risk for sure.
Yeah, yeah, and and that's I guess it's not always true. Like certain banks will just carve out certain things that they want to do, and it may be
Right.
like they may do all this stuff that makes sense, then one thing over here that just doesn't fit with the rest, but they've just decided for whatever reason that they want to do it. But so that's for us. We want to sit down if I get a referral or if it's an existing client or whatever it may be. I want to make sure that we're a good fit from
Right.
the first conversation, just to make sure I'm not wasting anybody's time. Granted, sometimes that's easier than others. If it's like a slam dunk, obviously, yes, we can tell pretty quick, like, yeah, we're going to find a way to get this done. It's really, or if it's something that we just know we don't do anything in that space. Then that one also, you can tell them quickly, hey, we're not a good fit. I can recommend you to some other bankers that I know because I know a ton in the city. I kind of know what they all do, and hopefully get someone to take care of you. But it's really those borderline deals that can take a little bit more time because they're like right there of what is underwriting going to support, what don't we know? And so it can and it just takes talking to the borrower, kind of getting an understanding, my mind wrapped around what they do, and kind of seeing what they're trying to do, whether it's buying real estate or equipment or a large line of credit, whatever it is. But it's mostly the conversation.
Okay, gotcha. How much does it matter when you talk to somebody about their previous experience? I guess you're working more with an owner user, so in this case it'd be, how much does it matter that they, will you do it with a a startup, or does it have to be an existing business, or how much does the background matter in their experience?
Yeah, it's a big deal. So that's a good question. And it typically, most banks you'll see won't do any sort of large lending for startups just because they
Right.
don't have any history. Because really the transition that I always explain to people is, when you're going to buy your house, we're looking at your income and, how much debt you have going out there, or we, as far as who the mortgage person is. It's a little different when you're trying to get a loan for business. We don't care. We still care about the owner, but we really care about the business. Like, can its monthly cash flow support this additional debt that we're adding on, whatever it is? It's equipment, real estate, whatever it is. That's kind of the super simple way to look at it. And if it's a startup, obviously we don't have that history to look at.
Right.
And that's really where you get loans like SBA and some of these other lenders that'll do some of that startup stuff. With that, obviously comes higher rates and more fees because it is riskier. And then that's when banks really step in once you've got a couple of years under your belt as an owner, and that you can show historically, all right, I can run the business can make money, I can retain some of these earnings and can afford to take that risk. So banks always say they're more risk adverse. They don't want to take as much risk, but the rates are usually reflective of that. You'll get better rates, less fees with a
Okay.
commercial bank than you would with like the SBA or some of these other parties.
Okay, that's interesting. Yeah. Okay, that makes a ton of sense. And then just moving into the difference in the process between an investor and an owner user. And like I said, we can spend a little bit less time on investor. But if I was a small investor and I wanted to get lending, I could still hypothetically come to First Citizens. Correct? I mean, that is a part of what you guys do as well, right?
For sure. Yeah. And, I think that's also a big differentiator between us and the other banks is what we'll lend on. Like there's certain, like office for right now is, I think most places are not lending much on that in the investment space. If it's owner user, it doesn't matter as much. But in the investment space, office is just really had been taking a beating.
Yeah, it does.
And even recently, I don't know if you saw the Business Journal just put out that a bunch of the towers in Nashville just got a lot of their value dropped. It was like they lost like 400 million in value,
Wow,
and
I did
so
not know that. That's
and
crazy.
it's significant. So there's still some risk out there with that. But outside of that, the easiest way I think to look at it is with an owner user, we're underwriting your business.
Okay.
With an investment property, we're underwriting the tenant. So we're looking at the tenant, the lease structure, what you're bringing in every month from a lease as far as the new owner, can that support your debt plus all your expenses? Is your NOI, is it enough to support whatever this loan is, especially with these elevated rates right now?
Right, right.
Versus as an owner user will tend to give a little bit more leeway on that because you're less likely to leave, to let your own business go than if you have to default on an investment property. Same thing, like you're not gonna, if you own your home and you also own like an Airbnb, and you have financial trouble, you're less likely to let your home go versus an Airbnb because that's where you live.
Right.
So that's
Yeah.
kind of what we look at.
Those are going to be the main differences. Okay. What is the main thing that you look at as an investor? I guess what I'm trying to ask is debt service coverage ratio, kind of the biggest thing that you're looking for if I'm coming to you with aspiring to buy an investment property.
For sure. Yeah, that's number one. Because if it doesn't work there, then the rest of it doesn't really matter.
Right.
Because what we don't want is if you're having to use your income from other properties to support a property we want the property to stand on its own.
Right.
And we'll make it, exceptions if you've got a lot of personal liquidity or other assets that are doing really well. We can bend a little bit, but if the property just doesn't support itself, if you're not even what we call 1-to-1 on debt service coverage, then it just doesn't make sense. And you don't want to do that anyway. I mean,
Right.
because that's a huge risk. But say you've got, like, for example, you're looking at an industrial property with a single tenant, and we look at that debt service coverage to be 1.25. And that just means that for every dollar you're paying out in expenses, whether that's, if it's not a triple net, if you're paying for taxes and insurance, if you're paying for electricity, utilities, whatever, plus that new loan payment, for every dollar that you're paying out, you're bringing in $1.25. So that little 25 cents is your buffer. Like I said, we can sometimes get a little bit lower, but that's kind of the golden number that everybody looks at. And then anything above that is just great. It strengthens the deal. That,
So
and
it's
then
1.25,
yeah, 1.25. And then the other big one, that's number one. The other big one is what we call LTV, loan to value. And that one, especially right now, has become a big one because, the last few years, values have just continued going up, especially in markets like Nashville and, the surrounding states, I guess, that are all kind of in the Southeast, is these values just keep going up. And so that's become, we've stressed that a little bit. To where if you're used to be, we could do 80-85% on a lot of these investment properties. And that's, if it's $1 million purchase, we could lend you 800,000 essentially. But we've kind of stressed a little bit where we're backing down to maybe 75, maybe 70, depending on what the asset is, because there's a fear that some of this stuff is going to kind of come down a little bit. And so we don't want you to be to a point where you're not able to, if the value comes down, you're underwater essentially on a loan. And I don't think that would happen on like industrial, but that's kind of the thinking there, why we don't do 100% financing essentially.
Right. And simply put, loan to value is exactly what it sounds like, right? It's the size of the loan that we will give you in comparison to the value of the property.
That's it.
Essentially.
Yeah, that's
So when you
correct.
say 85% is more standard today, that just means you're saying we can get to 85% loan, meaning that you need to come to the table with that 15%.
Yeah, well, yeah, sort of. 85% was kind of the max we used to have on investment. It's come down a little bit just because property values are a little bit less stable.
Right.
So it's probably closer to 70 or 75 now on investment. On owner user, it's still 85. Like I said, because the consideration there is you're less likely to let that one default. And that's pretty standard amongst most banks. Some owner user may be 80, whereas they may be a little bit more aggressive on investment property, but that's generally the numbers you're going to be looking at, assuming the debt supports that, right? So on investment property, you still have to, if I'm able to give you 75% of the value, well, we still have to make sure that your monthly lease income can support that payment and the debt service coverage and all that. So that's assuming, kind of making some assumptions there, but yeah.
Okay, perfect. So simply put, an investment property, the two biggest things you're looking at, and this is all after that initial interview. So we'd have our initial interview just deciding if, am I even a good fit in the first place? Okay, great. It looks like it could be a good fit. And then you're looking at mostly that LTV and the debt service coverage ratio. And that debt service coverage ratio is going to need to be above 1.25. Perfect. Okay, so now shifting gears to your bread and butter, an owner-user building. And I want to step back a little bit because I'm trying to make this as simple as possible, and so I want to be careful not to use too much jargon. So when we talk about owner-user versus investor, it's very self-explanatory, but an investor would be somebody that is looking to purchase a building simply for the reason of investment. Their company will not be operating out of the building, versus an owner-user building is what it sounds like. An owner will purchase the building for the specific use of their company. So the reason things are different is because an owner-user is not looking to lease this out to a separate company. His or her company is the company that will be occupying the building. So I just wanted to clarify that. I had that in my notes, forgot to do that at the beginning.
Yeah.
So anyway, but what is, so, and you've already mentioned this a little bit, but maybe go into a little bit more detail on how the process is different between an owner-user and an investment.
Sure. Yeah. And one thing I just wanted to add to what you said is owner-user also can be like if you partially occupy the building. And we're seeing a lot more of that now because people are wanting to bring in a tenant for, say it's a 20,000 square foot building and you want to occupy 10,000 or 9,000 or whatever it is. As long as you occupy it, you don't have to, it used to be 51%. It's not quite like that anymore, but as long as you occupy enough of it that it's considered, we would consider it owner occupied, that it's a good chunk, at least a third is kind of the loose rule, but then you can lease out a portion of it.
because I didn't know that distinction. So that's great. Okay, that's interesting.
And that's a little bit too, that can be different bank specific, and then you've got like SBA and they have different rules, and so a whole different thing there. But especially on the construction side, not to get too far afield, but when we do construction projects, we're seeing people do that a lot now, where if you need 10,000, well, they're building 15,000 with the plan of leasing out, partitioning out, leasing out that 5,000, just because lease rates are so high right now, and it can allow you to capture some of that revenue back every month. So, but yeah, to answer your question, it's similar to investment, but it's a little bit more of a process, because at that point we're really going to look at, I guess, investor. I mean, you can get that information quickly, right? I can look at an offering memorandum and see, or a rent roll and see, okay, quickly, does this make sense or doesn't it? What kind of LTV can we get to? And pretty quickly, it's either going to make sense or it's not. With owner user, we're going to look a lot more, like I said, at the financials. We're going to look at your balance sheet, your income statement, and really dive into what we call balance sheet leverage. Like I said, I don't want to go too far into it, but I would say if you're more of like a retail, or like what we call a non-operating company, like say you're a doctor's office or somebody it's pretty straightforward. You don't have a lot of what we call balance sheet leverage. Like you have your office, maybe you own your building, but you don't have a lot of big heavy equipment and things like that. Those are relatively straightforward. Where it can sometimes take a little bit more time is in the industrial space, because we'll have companies that have a lot more leverage, that have a lot more moving parts. Maybe they have some international customers or international receivables. Right. We look at accounts receivable, accounts payable. We look at, it just gets a lot more in the weeds, especially the bigger the project, if it ends up being, north of 5-10 million. Right. On the real estate side, it's just a little bit more, but it's also, that's kind of my favorite part, because we really get to know our customers, and I feel like that's kind of what can differentiate you and make you feel less like a commodity, maybe, is because we can talk and say, all right, help me understand this, especially for existing customers, because maybe they're at the point where they don't own a building, but in a couple of years they want to buy one. And we say, all right, here's what we need to kind of figure out between now and then. You've got this on your balance sheet that's kind of throwing it off. Let's talk, you, me, and your CPA, and kind of figure out, does this make sense? And really position them in a way that they're not, once they do it, they can just keep rolling, versus like, oh, maybe they've done something they weren't ready for. That's what we're looking at. And so just to keep it within real estate, it's typically, like I said, the minimum is 15% down. So it's $1 million building. We'll fund up to $850,000. And so you need to come with that other $150,000. Now, that doesn't have to be cash. That can be in the form of a seller note. But just keep in mind, if you do a seller note, which is just a loan where the seller is not, you're not paying them the full $1 million for the property. You're paying them $850,000, and then they're basically paying the other $150,000 over time. And the reason sellers will like to do that is it's a tax benefit. They don't get.
This is what we would, sorry to interrupt them, but this is what we would refer to in our world as seller financing, essentially. Yeah.
Yeah.
And so,
all good. Yeah. And just the benefit there is you get, whenever you sell a property, you have tax implications if you're not rolling it to another property. So you sometimes they'll want to do a seller note because it prevents them from taking that big chunk all at once, and then they're taking a little bit every year. So it's just, and it gives them some income long term, So there's all different reasons why people do that. But if liquidity is something that maybe you don't have the 150, or taking that 150 could potentially cause you to not have enough in your account in case something happens, or you need to put it towards something else. Like those are options. Or if you own, something we've done more lately is people have really built up a lot of equity in other properties. So if you've got other properties that maybe not even investment properties, or they have some equity, we can sometimes pull pieces of equity from other properties in order to piece it together. Because for us, we want you to maintain your liquidity. I don't want somebody that has, $200,000 in the bank, for that example we were looking at, and they take 150 of that out and they're left with 50, and especially with tariffs and some of these unknown potential expenses coming, I just don't want to put you in a building and then all of a sudden you're in a liquidity crunch and we've got a separate issue. So we'd rather figure out a way to piece that together if possible, and let you maintain your liquidity and keep it with us.
Right. Yeah.
But the other thing to think about is now if you do take little loans from here and there, if you do seller financing, that's another loan payment that we have to account for. So it has to make sense. At the end of the day, you still have to, And that number still on our side is 1.25.
Interesting.
We want to see it's essentially the same idea, but it's cash flow coverage versus debt service coverage. But it essentially functions the same way. We want to make sure that
So it's
all
my
your loan
business.
payments that you can pay
Is
them.
my business per year, netting 1.25 times what my mortgage payment will be in a year? Is that essentially the concept there?
Yeah, sort of. We just look at, the same kind of thing. It's a little bit easier, I think, on the owner user stuff because we can see,
Okay.
on your income statement, all your expenses or you're on your debt schedule or whatever it is. And we can just say, all right, by adding this, are you going to be able to make your payments every month? And also have that little 0.25 buffer that we talked about, And what's nice about if you're leasing a space currently and then you're looking to buy one is we can add back all that rental income or all that rental expense rather that you're paying. So we'll look at historical financials like over the last 2 or 3 years, depending on the size of the project, and say, okay, based on kind of how you've done, how you're ramping up or how you're growing, can you afford this going forward? So we typically will lean heavily on historical. We can look at projections a little bit. We can't lean as heavily on them as like SBA can, but we can kind of blend that a little bit just to make sure that, like I said, you can support the debt. Because ultimately, the bank, I've never met a bank or a banker that wants you to fail. It's you as the owner of the business. We want you to do the loan, buy the building, and pay your loan as agreed, and then use this for the next project. Because it's expensive. If there's a default on a loan, it's expensive for a bank to have to take that collateral, and it's not a good look reputationally. So 99% of the time, banks want you to qualify to pay it and keep rolling. Yes.
Awesome. Yeah, that's super helpful. It's crazy. I'm honestly learning so much, and I'm grateful for that. One of the things that I was interested to when we first connected was your guys' ability to kind of get creative. And you've kind of touched on this a little bit, but what are some case study situations, and you don't have to use specific situations, but as you think on those situations, ways that you can have been able to get creative for an owner user that, it might have been a little bit skinny as they first approached the underwriting or as you first approached the underwriting, but then you came up with a few different ideas. And so, yeah, what are some creative?
Yeah, I mean, real estate is nice because especially right now there just is a ton of equity that has been built up. And so that's good, but it's also hard when you're trying to buy that building where the value of it is jumped up. And so kind of the example that I was alluding to a little bit before is when we've got somebody we're looking at right now that just does not have the liquidity to put that 15% down. It's a larger purchase for them, and they're kind of consolidating a few of their locations into one bigger one. But with rates where they're at, and then just values where they continue to be rising, especially in industrial. I mean, it's like worth its weight in gold right now. I mean, and the vacancy rates are like essentially zero. They're like maybe 2%, but essentially nothing, and so sellers can really demand what they want within reason. And so, but we still have to do business. People still need spaces. And so for this one, since he just does not have it, it's not that he doesn't want to put it down. He just doesn't have it. And I don't want to take what liquidity he has, like I say, because he still needs to run his business. So fortunately, as we're talking, he has a pretty decent sized commercial real estate portfolio that he owns personally with fair amount of liquidity. And so what we're looking at doing is instead of having him put really anything down, he'll have to pay for some of the third party fees that we have. And we can talk about those a little bit later. But we're going to basically put what we call abundance of caution liens. So it's almost like when you buy your house, you have a deed of trust on the house. It's like that, but it's a little bit, it doesn't require a title company, but it is still a lien. And so we're going to put up to, say he's got, for this example, say he's got $2 million in total available equity. We're not going to take all $2 million of that because we want to give about 25% in case some of those values are inflated. So we're taking up to 75% of each of those properties, which is what's called an abundance of caution liens. We're putting liens on 3 properties, and that basically fills our gap. And then we're funding the full loan amount. So it almost feels like we're doing 100% financing, but we're not because we're pulling it from other places. So
That's right.
And what I like about doing it this way is we're not having him take loans out on these other properties, because if you do, anytime if I say, all right, I just need you, instead of financing 100% of this building, I'm only going to fund 85, and I need you to take loans out on all these other properties. Then he's got to get appraisals on those properties. He has to get title work done, potentially an environmental, depending on if it's like an industrial property, and the cost. I mean, you could easily spend $100,000 doing all that. So
Yeah.
this is a
And
way
time,
that,
too. I mean, I don't know how quickly you're able to, get your process, but I mean, getting an appraisal that can take 2 weeks, and then
Yes.
times 3 properties, and then all that. That's not a quick operation either. And a lot of times these owners, I can imagine, are like, hey, I'm actually, this building's not going to be on the market forever. To your point, the vacancy is incredibly low. I've got to be able to move pretty quickly.
Yeah.
I think that's probably a part of it too, if I had to guess.
Yeah. And so, doing stuff like this is kind of helpful because it shows that we're trying to save them money and also do it in a way that's not just like incredibly cumbersome.
Right.
With all the title work and things. So we're still working through that, but it looks good. The properties are all industrial properties, so we really like those. So it's all kind of a good fit.
Yeah.
And then, like I said, we still have to account for the fact that we're giving you a 100%, what looks like 100% financing on this purchase. Can your business support that at the current rates and things? And so, and it can. That was kind of the first thing we looked at. So you kind of asked like what we look at early. Like I'll get the financial, I'll talk to him, make sure we're a good fit. Look at the financials to make sure we're in the ballpark. Because if you're telling me you want to buy a $10 million building and the financials just aren't even close, then we need to either change our expectations or maybe look at SBA because they can do some different things with projections. But that's kind of the first thing that, like I said, and we try to do it quickly, but sometimes there's just so many moving parts that we want to make sure that we're not, missing something, especially if you have a lot of different things going on.
Right. And if you don't mind, tell us a little bit about an SBA loan, how that works, when a situation like that would be necessary.
Sure. So SBA is great. I mean, I feel like it gets a bad rap, and it's typically because the rates are higher and the fees are higher. And people almost feel like SBA is if you're a startup, once you've been in business for a while, and this is the feedback I've gotten, is like, I don't need an SBA loan. That's for people that haven't proven themselves. And, there may be some truth to that, but I think that for the most part, where I've seen SBA really work right now, especially, is because, like I said, you have those values that are high, and people just don't necessarily have that liquidity. So a lot of times we can come in on what's called an SBA 7A loan, and you may only have to put 5% down instead of that 15 that we look at.
Gotcha.
And the biggest one that SBA do is they can lean heavily on your projections. So say you're where that's helpful is you've got a business that's just growing really aggressively every single year. And so where that can hurt you is if we're looking 2 years ago at your financials historically, well, in 2023, those financials may not qualify for the loan you're trying to get now.
Right. Okay.
Because you've been growing so quickly. And then, but this year's looking great and next year's but we can't lean as heavily on projections, where SBA can look at projections, and as long as they make sense and you have reasons for why the numbers you're putting there are there and you can justify them, they can really run with that. And so I always look at SBA financing as almost like a bridge. Like if we need to do a 7A loan, yes, the rates are higher, the fees are higher, but there's only a 3-year prepayment on real estate. So if it allows you to get into your building and be where you need to be, and you can expand your business and grow, well, then in 3 years, when that prepayment burns off, we'll refinance it into a conventional loan. You haven't paid that higher rate that long. So you really haven't paid that much interest. And then you're in a conventional loan with the lower rate, and you're locked in at that point and off to the races.
Yeah. So it's kind of a way for, exactly like you said, a business that the growth has been happening. Their past isn't as bright as their future is looking. So it's based on projections and the continued growth of the business. And I think what I'm hearing and what we've discussed this before, but as an owner of a business that's interested in owning a building or even another building, I think a lot of people that'll be listening to this are like, I own a building. I've owned a building for a while. Would love to get a new one, but I don't have 25% down right now. Or maybe I do, but I'm not comfortable putting that into a building. But I hear a lot of creative financing opportunities, which I think is super. I don't know how many people even know that. And that's why I'm excited to make sure to get them this sort of information. And before we move, I want to talk a little bit about on a more macro scale, the market at a high level, and before we conclude. But there was one thing you talked about, some third-party costs. I don't know if that's something you want to touch on. Basically, is there anything else that, as an owner user listening to this podcast, that you would like them to know, or do you feel like that's kind of everything?
No, I would just tell anybody listening that if you've never bought a commercial building before, there's typically more and higher costs than when you bought your house or if you bought a house. I mean, and depending on the asset type. So sticking with industrial, because that's kind of what we do a lot of, you're going to have, and this is just a purchase, this is not construction. We do a lot of construction and it's a whole other can of worms. But if you're just buying an existing building, you're going to have a minimum appraisal and at least what's called an enhanced due diligence environmental. And that's basically, they're like $400 or $500, and they go in and it's almost like doing a comps on a house. They're going to look at the history of the property. Was it previously a chemical company or a gas station or something where there could be some kind of potential environmental contamination, or next door was there something, or within a certain square footage, was there something that could have contaminated the ground? Because, you don't know what's underneath. And if it's always been farmland or something, you're fine. But if there was an issue there previously, then that gets escalated. And the bank,
Right.
and this is every bank, it's typically required by the EPA, but they can require what's called a phase one. And that's where they go out and actually do some more additional testing on site. And it can get expensive quick. That can be $5,000 or $6,000. And then if there's further testing required, they'll go in and do what's called a phase two environmental. And that's where they actually dig down into the ground, and you're looking at 15,000 or more.
Yeah.
And it can be significant. So I always like to mention that, especially if it's something when we're looking at it and we can kind of tell based on where it is, like maybe there's some issues there, like let's talk about that. And we've had people walk away from deals before, and I don't blame them one bit. If there's an environmental issue, I would not recommend doing that, because basically, if something happens and there's some kind of contamination and you own that building, even though if you didn't do it, if something's discovered after, you're liable for that cleanup. And you're talking about, especially if people have been affected, I mean, the sky's the limit on what that could cost you. So that's why we do that. And then, so appraisals, those can be a few $1,000s. Like you said, they can take 2 to 3 weeks. And then title fees. And that's just based on the amount of, the size of the loan and the purchase price. But those are your big ones.
Yeah.
If it's a construction project, there's a whole lot more, because you've got, mechanical, plumbing, engineering, architectural stuff. But those are the big ones if you're just buying a place. So just something to kind of know on the front end that there's going to be some fees that are associated that any bank you go to, it's not their fees. It's all third party stuff.
Yeah, no, that is super helpful, and I'm glad you brought that up, because I think especially for a business that has been leasing and now they're ready to buy a building, I've noticed a lot of times people are shocked with the process, because they're like, I bought a house, I know how this works. But yeah, being in the business every day, totally different. So I appreciate you mentioning that. And then finally, we'll talk a little bit about the market today. I'll let you run with this question, but what is the state of the market as we speak? I know uncertainty is the word to describe the state of the economy right now, but from a banking and a lending perspective, what is the state of the market as we speak?
Yeah, I mean, if you're in an industry, if you're an owner user and tariffs are something that does affect your business, I mean, I think you've probably already discussed that with your clients and your suppliers, but that's something that the bank, if you're getting ready to buy something or get a big line of credit or something, the bank's going to be asking you about that. I mean, we've been having it, and it seems like for the most part, those costs are just getting passed to the next person, whether that's the end user. If you're a underground pipe contractor and your pipe costs are going up, aluminum from the EU or whatever it is, usually that's getting passed on from you to the next person. And so it ends up, and most people that I've talked to, that's just kind of, everybody understands it, but it's just something that your bank should be asking you about. So just keep that in mind, that they're going to want to know kind of how you're addressing that. It's funny, we were talking this morning kind of about where we were a year ago and where we thought we'd be now. Because, I mean, we're not directly tied on our lending rates to the 10-year treasury, but we kind of proportionally flow with that. And, back in August, September, October of last year, I mean, it dropped down to like mid threes. And so we thought, all right, here we go. Rates are finally coming back down. We're going to get back into like the 4s and 5s, which historically is great. I think everybody got used to the 2s there for a little bit. And, that just kind of was unrealistic. It was great at the time, but I think if you're in the mid 4s, low or high 4s, I think you can do a lot of things. And so we were thinking by this time or even later this year, we'd be maybe 2 percentage points lower than where we are now. Is kind of what we had all talked about. And we're not. We're about where we were, maybe a little bit better. But so I guess I'd say all that to say that rates, it looks like they're going to come down. Maybe next month they drop the Fed rate another 25 basis points. But I think that whatever happens is going to happen slowly. We're not going to have any big drops like we were hoping. So I would just tell people, if you were on the fence, or if you don't think, you're hoping for it to come down, you may be waiting a little bit longer than you hope. So it may make sense to move forward now, and see what you can figure out, or maybe change if you have to change your plans a little bit. But yeah, I don't see anything dropping significantly soon from the.
Right. I'm curious, just a little bit as an aside, but I know that the 10-year treasury is probably, like you said, your biggest predictor of where, you guys can get to it from an interest rate perspective. Is there a formula, or is there a general rule of thumb for, if the 10-year treasury is at 4.3, then banks are going to be lending, or is it's more correlation, but you can't really predict it in that way? I don't know if that makes sense.
No, it does. And it's close. I would say, so banks typically, they'll have their own internal, what we call cost of funds. And that's what, That's basically what it costs them to lend money. Now, depending on the bank, some banks have a lot more deposits on hand than others. And so the more deposits that you have, typically the better, the lower your lending rate is because you can lend your own money. And so I would say that on the 10-year treasury, it's usually the 10-year treasury plus 100 to 200 basis points. So if it's 4.5 today, your loan rate should be mid fives to mid sixes, somewhere in there.
Yeah. Yeah. Okay.
And that spread, what we call spread, is that covers the bank's cost, paying my salary, paying an underwriter's salary, the cost of these buildings and all that stuff. So that's why they charge that buffer. And I will tell you the biggest thing that I would say over the last probably 18 months that has helped us get really, really low on that rate is deposits, which is the funniest thing because it never used to matter before. Like if we got deposits or didn't, we didn't care. If it was a good loan, we'd do it. And now we'll still do a good loan, but the biggest mover on those deposit or on the rate is deposit. If somebody can bring over a solid deposit relationship, we can get really, really aggressive. Like we've gotten high fours on deals lately, and it's because we're getting a full relationship. And that seems to be pretty common amongst most banks because just some of the.
And unpack a little bit what you mean by deposit.
Yeah. So like, you think of like say a manufacturer, they typically have good deposits, typically holding those in there to conduct their business. So if you bring over operating deposits, that's, your operating checking account essentially, plus money market, banks will pay you a good rate on that money market funds because they want to hold those deposits on their balance sheet. And then it makes it less of a transaction, more of a relationship. And that's how we operate. With being a family-owned bank, we want family-owned companies. We want companies that are kind of like us, multi-generation owned. And we don't like just doing the transaction, which is why I think we do a little bit more owner-user versus investment, because investment can typically be a little bit more transactional. But that's kind of how we operate. And like I said, it's funny, it used to be, you'd want to kind of spread everything out and have here at this bank and this bank. Yeah. But now that's kind of changed. Like the more you have at one bank, the more aggressive they can get with you and the more things they can do with you. Like if you need if you're in a manufacturer and you need a big line of credit, but all your deposits are over here at another bank, it's going to be hard to get that. But it just gives you more leverage to have something with that bank for them to do some really cool stuff for you.
Right. So in other words, when and I'm glad that we brought this up too, because I wanted to make sure that we talked about it, but in order to get more aggressive, if I'm an owner user buying a building and I know the rates are high, I'd love to be in the, mid to upper fours or maybe low fives, but the rates are closer to, maybe 6. But a way that I could most likely get a better loan from you guys would be not only asking for a loan for a building, but also bringing my business accounts to your bank.
For sure.
Is that
for sure? Yeah. And that, it's moved from even less of it used to not even be a conversation, I felt like, and now, and then it became like an optional thing. And now it's almost like a requirement of, hey, if we're going to do, especially if it's a good size project, you're approaching 5-10 million, it's usually a requirement. And I found that most, prospects or new customers I've talked to have heard that and they understand. So that's why it pays to also, if you're with a bank that's not able to do what you're trying to do, or they maybe, we've seen some banks where they're just kind of like, hey, we're pausing right now on lending because they're trying to straighten some other things out. It's a good time to talk to a few different banks. If you've got a recommendation, that's great, but talk to a few, ask them what they're good at, don't just ask about the loan. I guess what I'm saying, make sure that, see what other things they can do, because banks can do some pretty cool things if it's an industry that they really want to work with, and they can maybe help you in other ways than just the loan,
Yeah. Awesome. Well, I keep coming up with questions, but I realize, you've got a life and you got to get back to it. So thank you so much for making time. I honestly have learned more than I expected to, so I'm grateful, and I know that this is going to be helpful for a lot of people. And I do want to allow anybody that does end up getting their hands on this recording, I want them to have access to you if you're okay with it. So for our listeners, and maybe it's one person, maybe it's more, but how do they reach you? If they would like to.
Yeah, I can give you my email and my cell as well. My email is Charlie, CHARLIE .Ogden, OGDEN @firstcitizens.com, and my cell is 615-979-9376.
Awesome. Well, I believe that's it, unless you have any final comments or remarks.
No, that's it, man. This has been fun. I appreciate you inviting me.
Well, thank you so much for coming on again. Thank you. I've learned a lot in the last 45 minutes, so really appreciate it, and I think our listeners will too.
Sounds good. Appreciate it, Neil.